Not on this computer. Okay. So hi everyone, thank you so much. So today we are going to discuss our questions on risk and return. From the mind map I had shared at the end of a lecture, you will see that the risk and return basically are calculated. Risk and return, they are discussed from two large angles. Number one, historical method, and I mean the data when we have some historical data, and when we don't have any data and we are uh, projecting something or estimating something for future, so it means it is a probability based model. Okay, so then we discuss in our lecture about the type of the data that we can use to calculate the risk and return, and then in B we also learned how to estimate the risk and return for single stock versus portfolio. Okay, so by the way, what was the purpose to make a portfolio? Why do we need to construct the portfolios instead of investing in single assets? Anyone?
Diversification.
Very good. So it is for diversification. Okay, so diversification is the major objective of making the portfolios or constructing the portfolios. Okay, so these are basically the major topics that are that are related to risk and return. So with time, if you will see that if you have any problem, we can discuss further. Okay, so first few questions are very easy. They will tell you how to calculate the return, mean historical return and historical risk. In the next few questions, we will see how to calculate the risk and return based on the probabilities, right? And then we will see how to estimate the risk and return for the portfolios. Okay, so these are the three major parts of today's tutorial. Okay, so first, the last 4 years of return for stocks are as followed: 1, 2, 3, 4. Okay, so if you see it is last 4 years, so it means we will be applying the historical method to estimate our risk and return if they ask us. Okay, so first of all, the question is asking us what is the average annual return based on the past 4 years return, and then what is the variance of the stock's return, and next is what is the standard deviation of the stock return. So standard deviation means what is the risk of getting the expected return. Okay, so risk and return we need to calculate. So since the data is historical data, so we can simply add all of the returns and divide it by the number, we will get the average return. Okay, so -4 plus 28%, 12%, 4%, we will get 10% on average. And what is the risk of not getting this 10%? Okay, so it means that -4%, and then individual return that we are going to get here minus this average return, individual return here, minus this average return, individual return, and minus this average return. Okay, so if I ask you, and then divided by n-1, in standard invariance we calculate n-1. Okay, if I ask you okay, so if I ask you what is risk, what do you say? You remember that in my lecture I had already explained what does it mean when we define risk. Can anyone tell me what is risk? Can you identify what is risk here in this question? Okay, if I say in other words, the risk is how much is the risk? What are the chances that I'm not going to get this 10%? Am I correct? Am I correct, students? Risk means, yes, Carl says yes. So risk means what are the chances that I'm not going to get this 10%. I'm not saying what are the chances that I'm not going to get this 4%, 28%, 3%, or 4%. Risk means what are the chances that you are not going to get your expected return? Expected return means this average return, okay, the average that you calculate. So this is called risk. Okay, so in this question this is 10%. Okay, so what is the risk? That is 13.6% chances. This is the variance, so if you take the square root we will get standard deviation. So there are 13.66% chances that we are going to get less than 10%. Okay, so this is our risk. If we get more than 10%, is it a risk, students? If we get more than 10%, is it a risk? No. Okay, so normally when and traditionally when we ask someone, hey, what do you mean by risk? So risk, they say uh, the risk, they say that 50% chances mean 50% chances that you're going to get something or you may lose something. So this probability is called risk. So the probability of losing your 10% return is 13.66%. Okay, so this is your first part you should understand. Okay, so next question. In this question we took the historical data. In next question we will see that we can also calculate the risk and return based on our estimate. Sometimes we don't know what will happen in future, like in your exam, like in your BFW 2140 unit, you don't know what are the outcomes you are going to get. Are you going to get HD? Okay, are you going to get D? Are you going to get C? Are you going to get P? Are you going to get what is that, F, right? So I mean we don't know. Sometimes students say that there are 10% chances that you are going to get HD, 55% chances D, 20% chances C, right? So it means that what are the chances that you are going to get a certain average, okay, on expected average. So because you don't have any historical data, so then what do? You make estimates. Okay, so let's say the question says that the company is expecting the following outcomes, that the probability of occurrence means there are 10% chances that company will make loss, 20% chances it will get 5% profit, 40% chances are that we will get 20%, and so on. As you can see, since it is in the future, we don't know what will happen. Since we don't know what will happen, so we divide our estimates into different guesses or different probabilities. Okay, so then we average them all to get our average return, right? Like here we also got 10%. So how do we get in this situation? Simply we multiply. Okay, so what do? We will multiply all the probabilities and their associated return. Okay, so 10%, so it means this is PI and return I mean individual, right? Individual probability, individual return mean at this individual probability, what is the individual rate? That is negative 10%. So simply multiply all of them and then add them. Okay, so whatever is the answer will be your average return. So how to do that? So let's get it. So you see that there are 10% chances we will get negative 10, 20, and 50%. So what are the total chances? 100% chances. Okay, so then we will multiply simple P and R. So we will get 0.01. So this is also called the deviation. Okay, so this is the deviation when we have 10% chances, deviation. So what is the, you add them all, sorry, you add them all, you will get return. Sorry, it's not deviation, my bad. So simply multiply your probability with return and add them all, you will get return. Last time you divided the return by n and you got it. Since it's probability, you don't need to divide, so this will be your answer. So it means the expectations are, on average, the expectations are that we will get 20%. But what is the risk? Simply, so what do? This is your expectation. So you simply subtract your expectation from individual return. Okay, So this is 10% minus this 20%. Okay, then this 5% minus this 20%, then this 20%, and then 20%. Okay, so it means that this is called the deviation from the mean. So this is mean and this is the deviation. Okay, so possible return minus mean is called the this is called the deviation from the mean, but since we have taken the square, it will become square deviation from the mean. And then since it's at 10%, we multiply 10%. Okay, so if you will see that in the lectures about the variance and the standard deviation, we say that the variance is the square deviation from the mean. Okay, so when we remove the square, it will become standard deviation. Okay, so deviation from the mean, deviation from the mean. Okay, so this is individual return minus 20, mean deviation from the mean, and square, it will become variance. So when you get this, it is variance. So when you take the square root, it will become standard deviation. Okay, a simple questions of calculating risk and return using the probability. Next questions, once we have got it, next question is to, in this question, in the previous question, we learned how to calculate risk and return using historical and probability method. Next, we are moving towards portfolio. In portfolio, we will calculate how to calculate the portfolio return and how to calculate the portfolio risk. So this question is dedicated for the portfolio risk, sorry, return. So let's say you have 70,000 as your net worth. So you put 20% of your money in a stock with an expected return of 12%. Okay, so this is the weight of one investment that you're going to put in this return stock. The return is this one. Okay, so I call it as 1 and 1. Okay, you will put 20% of your money in an investment that will give you 12%. Okay, then you want to put 30,000 of your out of 70,000. So this is, just give me a second, let me, okay, so it was not plugged in. Yeah, so you want to put 30,000. We need to calculate the weight because it is given in amount, so it will be 30,000 divided by 70,000. We will get weight of 2. Okay, in a stock with an expected return of 15%, so this is R2. Okay, and rest in a stock with an expected return of 20%, so this is R3. But we don't know where is W3. Okay, what is the expected return of your portfolio? So we need to calculate the first the weight of 3, and then it will get easy to calculate the expected return. So expected return of a portfolio is equal to weight of individual security and return of individual security. So this is sum. Okay, so it means that we need to add all of them. So first of all, weight of 1 is given, R1 is given, so we will multiply it plus, so this 42.86 is the answer when you divide 30,000 with 70,000. So this is weight of 2, and return of 2 is equal to how much? This 15%. Okay, so this is return 2. So weight of 1 R1, weight of 2 R2, plus, since you don't know what is the weight for the third one, but you know the weights, the existing weights, this is weight of 2, weight of 1. So total weight should be 100%, right? So 100% mean 1 minus weight of 2 minus weight of 1. So you will get weight of 3. So this is weight of 3. Okay, so this is weight of 3 multiplied by R3 is already given because in this question R3 is given. Okay, so the answer would be equal to 16.26. So this question actually has had a mix of estimating the weights. Okay, sometimes the weights are not given, amounts are given, and sometimes you have to calculate the weight based on different other weights. So this is just a small variation, but the question largely focuses on estimating the return of a portfolio. So return of a portfolio is always equal to weight multiplied by return, weight of A, R of A plus weight of B, R of B, and so on, right? So this will be the formula for expected return of the portfolio. Any questions so far, students? Okay, so please remember one more thing. Okay, I will show you the question itself. Okay, so this question I have added this question particularly in your tutorial because last time this question was part of your final exam. Okay, so you can see that how easy what would be the question. So this question was given because if I give you 5 questions, maybe 2 or 3 questions would be difficult, relatively difficult, but I will accommodate you with easy question as well, so that you can save some time and marks from the easy question and spend more time for the difficult questions. Okay. Stocks A and B have the following returns. Okay, so stock A has 1, 2, 3, 4, 5. Stock B has, these are the returns 1, 2, 3, 4, 5. Okay, so is this a historical data or probability based data, students? Anyone? Are we given historical data in this question? Yeah. So Carl says probability. Anyone else? Anyone else who agrees or disagrees to Carl? Okay. So first of all, as we know, let's say if I draw a timeline, okay, if I draw a timeline, mean 1, 2, 3, 4, and 5. Okay, so it means that I'm talking about something in future, right? Future, future, future. If I'm standing here, so it means that if you have to calculate the return in year 1, in year 2, in year 3, in year 4, and in year 5, you must be given probability. Okay, so you must be given probability to calculate the return in year 1 for year 2. So you have to calculate that. So if you are claiming that it is probability based data, so you must be given probability at least, right? So in this question, there are no probabilities. So if you check the formula, it's a simple historical data that you just added divided by n, right? So please remember that if you see in this question, this is a past data. If it is a probability based data, you will be given some probabilities. Okay, so if I add probability, let's say 10%, 20%, 10%, then 40, 30%, and 30%. So if I add probability as well, then you will calculate the expected return and then risk. Since this is not given, right? So it means that it is not a probability based data, it's just a historical data. Okay, so first of all, we need to calculate the expected return. Then we need to calculate the standard deviation of the returns of the two stock, means we need to calculate risk. Okay, so we need to calculate return, risk, and then if their correlation is 0.48, what is the expected return and standard deviation of portfolio of 65% stock A and 35% stock B? So it means in this part, we will calculate expected return of the portfolio and variance of the portfolio. Okay, so we need to calculate that. So we have covered all of that in the question. Now, first of all, let's look at the solution, first of all, it's a very simple uh, uh, equation. We need to add all of the returns 1, 2, 3, 4, 5 divided by n. It will be your expected return for A. Similarly, you will also add all of them to get the return of B. Okay, if I just don't show you the return risk, so which one do you expect that will have higher risk? What are your expectation about the level of risk for A and B? Which one have high? So Kwa says it will be A, yes, because higher risk should also means that there will be, sorry, higher return should also mean that it should have higher risk. Okay, so we are expecting that the risk of A should be higher than the risk of B. So if it is not like that in your answers, then it means that there is some problem that you have not actually considered. Okay, so in your answer there could be a problem. So now simply we need to calculate the risk of A and risk of B. So variance mean uh, square deviation, right? So this 0.08 minus this average. So 0.08 minus this average return and square, it is a square deviation plus the second return minus the average and square will be again square deviation and so on divided by n minus 1. Okay, so the answer would be 0.0049, in other words 0.0492%. Okay, so this is the risk for A, and what is the risk for B? We need to calculate. For B, similarly, we have return of A, B. So we need to subtract this answer from individual return, mean from 0.059 minus this return 0.04 minus this return and so on, right? So we will do it for our security B. So 0.05 minus 0.028 square, it will be square deviation, then 0.04 minus 0.028, right? Square and so on, and minus 1, and that would be your answer. Okay, so as we can see, the standard deviation of A is 0.0701 and standard deviation of B is 0.0268. Okay, so as you will see that the since this stock had highest return, so it should also have the highest risk. Okay, so this is risk and this is return. Okay, so for this stock B, there is a lower return, so that you can see that there is a lower risk as well. Okay, my question to you is that if I make a portfolio, okay, if I make a portfolio of A and B, A and B, if I make a portfolio now, previously I calculated the return of A, risk of B, A individually, return of B, risk of B individually. But what if I make a portfolio of A and B, and then I will calculate similar to individual stock, I can also calculate return of portfolio and risk of portfolio. Okay, so what do you expect? My question to you is, what do you expect about the return of the portfolio? Would it be higher than A or lower than B or in between? What do you say? Okay, let me put the question this way. If I make a portfolio, and you know that when you make a portfolio you are diversifying, right? So it means that you are doing the diversification, and when we understand the diversification means lower the risk, right? Lower risk. So which one of the two has the highest risk, students? A or B individually? Yeah, A has the highest risk, right? Lower the risk it means that A has the highest risk. So when I say the diversification, I am decreasing the risk of the portfolio because I know that the individual security has a highest risk of 0.07, right? So it means, what do you expect? When I calculate the risk of the portfolio, would that be higher than the risk of A or B? This risk, if I calculate this risk, will this risk be higher than the risk of A, or higher than, or higher than risk of A, risk of B, sorry. So what do you expect? Or in between, if I call? Okay, let me explain it through this way. Security A and B, this has return risk. Okay, similarly security B has return and risk. Okay, so what are the, okay, 5.8% is the return, 0.7%, 7.1% is the risk. Okay, return for B is 2.8% and risk is 2.68, 2.68%. Okay, so these are the returns that I calculated. So it means that if I make a portfolio, I am combining A plus B. Okay, and the purpose of making this portfolio, as you remember, is to reduce the risk. Reduce the risk. So which one has the highest risk? You say, sir, it is A, right? Because you know the security A has the highest risk, 7.1%. So it means if you make a portfolio, so you will diversify this risk, mean you will reduce this risk. Okay, but for B, B has the lowest risk. So no problem for the B, but the problem is for A, right? So when you make a portfolio, what are you trying to do to lower the risk? Which risk? The one which has the highest level of risk, right? A. So it means if I will make a portfolio, so the risk that I will calculate would be less than A or greater than A. If I make a portfolio, and portfolio means diversification, mean reduction of the risk. So what do you expect? Less than A. Very good. Carl says less than A. It means that when I'm making a portfolio, the risk should be less than 7.1%. Okay, so we will expect that risk of the portfolio will be less than A, and you will see that. And when B, it means that it will be in between, right? In between A and B, higher than B but lower than A. Okay, risk would be higher than B and lower than A. And similarly, when the risk will reduce, the return of the portfolio will also reduce. Okay, so let's do that and you will see the justification. First of all is the expected return. So weight of A, in the question it was given, okay, 65% in A and 35% in B, and correlation is 0.48%. Okay, so it's a very simple case. So we need to calculate the expected return. So weight of A, R of A, weight of B, return of B. And when you do that, so the answer would be 4.75%. 4.75%. Can you just compare what is the return of A? A's return is 5.8% and B's return is 2.8%, right? So it means that if you see, the answer is in between these two. Okay, so the risk of the portfolio, return of the portfolio will be lower than A but higher than B. Okay, so similarly, same would be the case for the risk as well. Okay, So how to calculate the risk of the portfolio? Risk of the portfolio is equal to weight of A square multiplied by standard deviation of A square plus weight of B square, standard deviation of B square plus 2 weight of A, weight of B, and correlation between A and B. So since they are squares, so we take the square root to get the standard deviation. Okay. So if you see 0.65 is the weight and 0.049 is the standard deviation. Okay, so they did not take the, if you see this one 0.0049, so instead of standard deviation they have just used variance. You see this one, they have used variance, mean they did not take the square already. They did not use this 0.071, but you can take 0.07 as well, 0.0701 square, you can do that, right? And also you can do 0.0268 square. Okay, so weight of 1, standard deviation of 1 square, weight of 2 square, standard deviation of 2 square, plus 2, weight of 1, weight of 2, standard deviation of 1, standard deviation of 2, and the correlation. And if you see the answer is 5.08%. Okay, 5.08%. Okay, what is the risk of the highest risky asset? That is 7.0%. What is the risk of the portfolio? That is 5.08. So it means that the return is in between these two, risk will also be in between these two. Okay, so lower than the risk of the A, that is 7.01%, but higher than the risk of B, that is 2.683%. Okay, so if in the test, if I write it like that, if I don't give you any calculation, if I say security A has a return of 5%, has a risk of 8%, right? Security B has a risk of return of 2%, and risk is 4%, right? So if I ask you, just theoretically, if I ask you, what would be the return of portfolio, right? So I can ask you higher than A, okay, lower than A, okay, higher than B, and lower than B. What would be your answer? If I'm, yeah, lower than A, higher than B. Very good. So your option would be A, B, C, D. So it would be lower than A. This would be your option. Okay. So it means then if you understand the concept, so it won't be very difficult for you to get the answer. Okay. Sometimes the quiz information is missing, and based on your understanding, you get the answer straight away. You don't need to do all the calculations. Okay. If the questions ask you just a simple thing, sometime if you do all the calculation and do the answer, but if you are smart or you understand the concept, then you can easily answer this question. Okay, thank you. Yeah, that is the answer. Carl, you're both right. Okay, so now let's get to question number 5. Now you have a portfolio. I mean, this question is already in portfolio with the standard deviation of 30%. Mean in the question, the risk of the portfolio is already given. You don't need to calculate that. Okay, so the risk of the portfolio is 30%, and expected return of the portfolio is 18%. So risk and return of the portfolio is already given. Okay, so what would be new? So let's see. You are considering adding one of the two stocks in the following table. So since you have a portfolio and you don't know how many securities are there, but you know two things, the risk is given, return is given, right? So no worries. But now you have two securities in hand, A and B. So you are thinking that I want to keep 80% of my portfolio like that, but 20% I want to invest either in A or B. Okay, so this is the question all about. So we need to discuss whether should we add A or we should add B. Okay, so before we discuss the answer, let me ask you a very simple question. Before adding the securities, what would be your preference? If I ask you, I mean, you are the one who is deciding this. If I ask you, what would be the criteria to add the asset? Let me write two criteria. Number one, high return. Number two, lower risk. So what do you think, which one would you add based on these two criteria? The one with the higher return, and two, the one with the lower risk? Anyone? If I ask you that based on these two criterias, which one would you add in your portfolio? The one that is giving you highest return, or the one that is giving you lower risk? Okay, very good. Qua says higher return. Anyone else? Okay, so you will say, sir, based on, I mean, we both can be right. We can also add something that has the lower risk, so that when we add it in the portfolio, it reduces the risk of the portfolio, right? Or maybe we can add something with the higher return. Higher return of this stock means that maybe this stock has the highest risk as well. So if I add it here, it will increase the risk of the portfolio, right? So that's why we need another information, that is the correlation. Correlation means, if let's say in this portfolio, majority of the stocks, not all stock, I'm saying that majority of the stocks are utility stocks. Okay, majority of the stocks are utility stocks. There are two stocks now that I want to think of adding. A is a utility stock, B is IT stock. Now which one would you think has the higher, more similarity with the portfolio? Which of the asset has the more similarity with the existing portfolio? A, because A is utility stock. Already we have majority of the stocks that are already utility stocks. So if anything or bad news or any news or any information uh, occurs and we lose the return, if we add this security in the portfolio, so it will further increase our risk, right? But if we include another stock that is not related with this existing portfolio stocks, so then it could help us. For instance, let me add it here. Let's say majority of the stocks include the utility, means maybe we have oil. Okay, the stocks of Shell, stocks of some other, I mean, majority of the stock you can see are the oil stocks, right? So if you want to add A, and that is also an oil stock, and B is I would say that maybe that is, I will say, let's say top globe, or maybe any other that is not oil stock, something IT stock. Okay, so this is a situation. So let's say if a Ukrainian war, when the Ukrainian war happened, what happened to the oil market? I mean, the people who had portfolios of oil, they made huge losses, right? I mean, I'm just I don't know the existing situation, but I'm assuming that when the Ukrainian war happened, there was a shock in the supply. So when there was a shock in the supply, there were disruptions. So maybe the portfolio had, since the portfolio had all the stocks that were oil, so it means that if I add one more stock that is also that is also an oil stock, so it will further increase the risk of this portfolio. But if I add IT, maybe the oil stocks are making loss, the IT stock is making profit, right? So the loss in one stock is being balanced out by the IT stock. Okay, so it means that if we have, if we want to add a stock that has the highest similarity with our portfolio, we should not add that. Okay, if a stock that is not similar to our existing portfolio, means all the stocks are oil stocks, then we should add it. So it means that we are doing the diversification, right? So if we adding majority of the stocks that are oil stocks, that is not a good diversification. But in that diversification, if I add IT stock or food stock or other stocks, it means I'm increasing the diversification, right? So this question is a very classical example to understand this concept. So if after adding the stock, you will have 20% of your money in the new stock and 80% of your money in the existing stock, which one should you add? As you can see, based on the expected return, both of the stocks, they are giving you the same return, right? So if I don't write this information, what it should be the criteria? You remember that at a given level of return, at the same level of return, you always choose a stock that has the highest return or the lowest, sorry, highest risk or lowest risk. If you are just given these two informations, yeah, lowest. So it means that at a given level of risk return, you choose a stock that is giving you the lowest risk. So you will choose B, right? So, and we can also reverse the situation. So let's say 20% and 20% and 15 and let's say 18%. Okay. The situation is at a given level of risk, which one would you choose? The one that is giving you the high return, right? This one, the low, and this is high return. But since we are making portfolios, this third component becomes very important. We also need to look at the correlation with the existing correlation of these individual securities with the existing portfolio. Okay, so we need to see that. Okay, so 20% is 20%, this is 60%. Okay, so as you can see, if I add stock A, it has a 20% similarity with our existing portfolio. Okay, so this is 20% similar to our existing portfolio, and this stock B has a 60% similarity with our existing portfolio. So which one will add more risk, A or B? B. Yes, because stock B is more similar to our existing portfolio. If I add B, so it will make our portfolio more risky. But you will say, sir, B has low risk. So that is correct. But if you are not making portfolio, then this should be the choice. But if you are making a portfolio, then you should also look at this correlation. Okay, so let's see if it is true or not. So it means first situation is that you are putting 80%, you are the return, because the return would be the same for both of them, right? If you calculate the return of the portfolio, so it is weight of A and return of A plus weight of portfolio, return of portfolio. Weight of A is 20%, return of A is 15%, weight of portfolio is 80%, risk of the portfolio existing is 30%. Sorry, return is already 18%. 18%? Yeah. 18% for A. Okay. If you add B, return of the portfolio will be weight of B, return of B plus weight of portfolio, return of portfolio. Weight of B would be the same because you want to add 20% in either securities. And the return of B is also 15%, right? 80% and 18%. Since both of them will give us the same result, so that's why we are not adding return in this question. We are directly starting from the risk. Okay. So, so it means that this is the when we add A, so what would be the risk of the portfolio? Okay, so this is beta portfolio, standard deviation of square, standard deviation of portfolio square plus weight of A square, standard deviation of A square plus 2 weight of portfolio, weight of A, standard deviation of portfolio, standard deviation of A, and correlation between A and portfolio. Okay, so if you solve this, you see that your answer would be 25.48%. Okay, so it means if you add A, the risk of the portfolio will be 25.48%. What was the existing risk? Existing risk was 30%. Okay, so from 30%, the risk moved to 25.48%. You see, 30% was mentioned if you are confused. Okay, so 30% from 30%, our risk reduced from 30% to 25.48%. If we repeat the similar thing for B, so this part will remain the same: weight of portfolio, standard deviation of portfolio, weight of B, standard deviation of B, and weight of 2 and 2 weight of portfolio, standard deviation of and weight of B, standard deviation of portfolio, standard deviation of A, and correlation between portfolio and B. Okay, and the answer is 26.59. So 30% to 26.59%. So which one do you think is adding more risk? It means that if we add A, so our risk will be 25.48% from 30%. Okay, and if we add B, our risk will jump to 26.59. It is decreased because diversification, right? Diversification reduces the risk, but how much risk does it reduces? I mean, based on the individual securities risk. So this is the difference. Okay, so which one should we add now? Because A is reducing our risk of the portfolio, we are going to add A. So you have to take you have to remember one thing from this question is that when you are making portfolio, the most important thing that you will see will be this correlation between the individual asset and market portfolio. Okay, so this is market portfolio or portfolio. Okay, so this is called the correlation that you need to look at. Okay, next question. Suppose Intel stock, this question is basically capital asset pricing model. And the capital asset pricing model, you know that in the capital asset pricing model, we write it like that: RE is equal to risk-free rate plus beta, return of the market, minus risk-free rate. Okay. Okay. If you just look at the capital asset pricing model, so it says the capital asset pricing model. Capital means we understand that long-term assets or mean stock, right? Stock asset, capital asset mean stock. Okay. Pricing model mean we need to calculate the price of the stock, a model that calculates the price of the stock. But as you can see in this formula, can you see any price? Can you see any price? Because if you see the formula, it is capital asset mean stock pricing model, pricing the stock through this model. Okay, but where is the price in this question? Can anyone tell me? Why do we call it? Since we are calculating return, it's not price, then why do we call it capital asset pricing model? Anyone? Anyone? You can make a guess, no problem. I will help you. That's why I'm asking this question so that I can help you. Okay. So in case if you, if okay, so you see that the price of a stock, we remember that from the stock valuation model, the stock price was equal to dividend divided by RE minus G. Okay, so it means that the price of the stock is equal to dividend divided by cost of equity minus G, or return on equity minus G. Basically, capital asset pricing model gives you this component. Okay, so once you get this component, then you calculate the price. Okay, so capital pricing model itself does not directly calculate the price. It gives you a component called cost of equity. Cost of equity, if we are talking about the firm perspective, but from an investor perspective, it will be return on equity. Okay, so capital asset pricing model, remember, does not directly give you the answer of price. It will give you RE. Using this RE in this formula, you will get price. Okay, so that is why we call it as capital asset pricing model. So this capital asset pricing model can be used to because we know that this can calculate RE, right? RE means return on equity, or cost of equity mean one stock, but it can also be used to calculate the return of the portfolio. Okay, this is you need to remember. Okay, capital asset pricing model can help us to calculate the cost of equity or return on equity in single asset, but we can also use use it to calculate the return of the portfolio, because return of the portfolio, remember, it was equal to weight of 1 R of 1 plus weight of 2 R of 2. But in the capital asset pricing model, there are no weights given, but we can calculate return of the portfolio through this model. How? We will show it. Okay, so these are the things that you need to remember. First of all, suppose Intel stock has a beta of 1.6. 1.6 means it is more risky, 60% more risky than the market, whereas Boeing stock has a beta of 1. So similar to market. So this is not much risky, same risk like market. If the if the risk-free interest rate is 4% and the expected return of the market portfolio is 10%, according to CAPM, what is the expected return of the Intel stock? Okay, so this is the return of the market portfolio. This is RM. This is risk-free rate. These are the betas. Okay, so now first two questions we need to solve it. So as you can see, first two questions, Intel expected return is equal to risk-free rate plus beta RM minus RFR. This part is also called excess return. Okay. Okay, so as you can see, the return of the stock of Intel is 13.6%. Return of Boeing is return of Intel, and return of Boeing is 10%. So it means that why do we need the capital asset pricing model? Because capital asset pricing model gives you what? It gives you return, right? Return. But you will say, sir, just now you told us that you can calculate the return using simple A plus B plus C plus D divided by 4, right? We did that. Similarly, we also calculate return through probability and to RI summation, right? So we also calculated that. Then you will say, sir, why are we doing that? Because these factors, they are just taking the past returns They are not considering the other factors. So it means this is one way to calculate the return. I mean, this is not a wrong way. You can also calculate return if you are given historical return, but for the future return, you will use CAPM, right? So that is why it is also calculating return for you, return for you. Intel has higher risk than Boeing because Intel has more systematic risk than the Boeing. Okay, so this is we got it. But now if I ask you, this is the beta of Intel, beta of Boeing. But if I ask you what is the average, if I make a portfolio of Intel and Boeing, so what would be the portfolio beta? So beta, this beta can also be calculated as a weighted beta. So it means that the weight of Intel, beta of Intel plus weight of Boeing, beta of Boeing. Okay, so you see this information is given. What is the beta of a portfolio that consists of 60% Intel and 40% Boeing stock? So once we get the portfolio, the question is asking us, what is the expected return of the portfolio? Here, the question is asking us what is the expected return of one stock. What is the, in the second part, the question is asking us what is the beta of the portfolio. And in the D part, the question is asking us what is the risk return of the portfolio, individual, and portfolio. Okay. So return of the portfolio, we know that we need to use weight, but since we have we also have the beta of the portfolio, so it will be equal to 1.36%. Excuse me. So what is the expected return of the portfolio? So we are calculating the return of the portfolio, but this time we are calculating it through capital asset pricing model. Previously, we calculated the return of the portfolio through this method, weight of 1, return of 1, plus weight of 2, return of 2, right? This was the method that we used last time, but if you are just given the beta of the portfolio and you are not given weights, then you can easily also calculate CAPM, use CAPM to calculate the return of the portfolio. So that is 4%, same RFR plus beta, this time beta is 1.36. And you will see here as well, the beta of the Intel is 1.6 and the beta of the Boeing is 1, but beta of the portfolio is 1.3 in between, right? You will see that. And also you see that the return will also be in between because Intel has the highest return, that is 13.6, and Boeing has the lowest return, that is 10%. So it will be, the answer for the portfolio will always be in between of the two assets. Okay. Now, from this concept that I just discussed, okay, you need to understand. Okay, so it means that okay, so there are two things that you need to remember. When we will use CAPM, we will get RE, we use RE and we calculate the price. Let's say the price is 110. Okay, so I call it as the true value. Also I call it as intrinsic value. I also call it as fair value. Okay, I also call it as should be value. Okay, so when you use a formula, any formula and get the answer, that answer is not the actual price in the market. That is according to you, right? In other words, according to you. Okay, so this is the price that is according to you, but maybe in the market the price is 90, right? So according to you, the price should be 110, but in the market the price is 90. This is the market price, this is according to you. Okay, in other words, this is the true value, this is the intrinsic value, this is the fair value, This is the should be value, or according to your calculation, right? So this is called the true value, and this is called the value in the market, and this value is normally affected by the demand versus supply. Okay, so this price is affected by demand and supply, but this price that you got through the formula, okay, formula is very important. Whatever you get through the formula should be right. So it means that this is the price that should be for this stock, but in the market it is 90. So may I ask you a question that if 110 should be the price, but in the market it is 90, so is this stock is undervalued in the market or overvalued? Okay, undervalued, very good, because because it means that undervalued mean that this stock is trading at a lower price than it should be traded, right, at 110, right? So it means that the price, I will be happy to buy this bond, this asset, because this is cheaper, right? And I was ready to pay 110. According to me, its price should be 110, but in the market it is 90. So I will call it as undervalued. Undervalued, in other words, so let's say let's say, okay, let me write some information for you. Okay, RE is equal to 10%, this 10%, okay, G is equal to 2%, D is equal to 4. Okay, so what is the answer? Can you calculate the answer for me, students? D divided by R minus G. So let's make it a very uh, real thing so that we know what are we doing. So R D is equal to 4, R is equal to 0.10 minus 0.02. The answer is okay. Can you calculate the answer, students? 4 divided by 0.08. So let me calculate that. Let's say it's 50. Okay. So the answer is 50. So according to me, the answer should be 50. But let's say in the market, it is 40. Okay. So what does it mean? It means that I am requiring 10%. If I require 10% through CAPM, because this 10% I got it through CAPM. Okay. So if I require 10% from this stock, its price should be 50, right? So, but in the market, the price is 40. So what does it mean? It, can you tell me whether the investor, when the price is 40, if I put 40 here in this formula, if I put 40 is equal to 4, R I don't know, G is 0.02. Because the price in the market is 40, how much are the investors existing investors are requiring from this stock? Because current stock market price is 40 and the dividend is 44. 2 is the how much are they requiring, investors are requiring from this stock? Can you calculate? Please calculate that. Let me know if you are calculating. Actually, the phone or the calculator is not with me, so please calculate that. The answer should be higher than 10. Yeah, very good. That is 12%, right? So now understand this. This is very important. Okay. CAPM told us that we should expect how much? 10%, right? From CAPM we got is 10%, and when we require 10%, the price of the stock should be 50. But in the market, what is happening? People are requiring 12%. When they require 10%, the price will decrease, right? So if it means that people should require 10%, but they are requiring 12%. Okay. Now please understand this very carefully. The people should require 10% because at 10% the price should be 50, right? But in actual, what is happening? The price is 40. What does it mean? That the existing shareholders are requiring how much? 12%. Okay, so why? Because they think they are risky, or how, we don't know, but they are requiring higher than it should be. They should be, right? 10%. So it means that in the market, people are the asset is undervalued, right? So when it is undervalued, it means the people are requiring higher return. So that is why in the denominator, when I do that, dr minus g, if this denominator increases, the price will decrease. Okay, if this one decreases, the price will increase. So now please compare this situation. CAPM says that it should be 10%, but in the market, people are requiring 12%. Okay, so at 10% the price was higher because here the denominator will be lower, the price will be higher. But in the existing situation, they are requiring 12%. That is why it is giving us 40. So it is undervalued. So in the next question, we will discuss the undervalued or overvalued. Okay. Okay. So when I say undervalued, okay, so when I say undervalued, so it means the price is lower, but the required return is higher. Are you getting me? If I say undervalued, undervalued mean the price is lower than it should be, but return on equity is higher than it should be. Okay. Or in other words, required return is higher. That is why the price is lower. Okay. So that it is making the asset undervalued. So we will see how it is happening in this question. Okay. So I hope this will help you to understand the coming explanation. Currently, the risk-free rate is 10%. Expected return on the market portfolio is 15%. So this is risk return of the market, and this is risk-free rate. Market analyst return expectation for 4 stocks are listed here together with each stock expected beta. So please help me to solve this question, because this is now it means that existing shareholders for this stock are requiring 17% in the market. This is a similar situation what I explained here, 12%. Okay, so it means that existing shareholders are requiring 12% in the market. Okay, in this situation it is 17. For this stock they are requiring 14.5%. For this stock they are requiring 15.5, 18%. Remember, these returns are not should be, they are what is happening in the market, actual thing in the market. Okay, last time 12% in the previous example, here these are the cases. But what should be the return? What should be? How can we calculate that? We can calculate it through capital asset pricing model. Okay, so it says that risk-free rate plus beta RM minus RFR. So we need to see that people are requiring 17% in the market. Is it the true rate, or are they requiring higher, or are they requiring lower? Okay, so can you calculate the answer for me? Risk-free rate is 10%, 0.1 plus beta is 1.3, 15% minus 10%. What is the answer, students? for the first one? Very good, 16.5%. Okay, for the second one, 0.10, 0.8, and 5%. For the second one, 14%. Okay. Now let's calculate all of that, then we will see. 0.10 plus 1.1, 5%. 5% means 15 minus 10%. Okay. For the 16.5%. Are you sure it is 16.5? Third one, Carl. Okay. How about the third one? It is 15.55%. Please make sure that you are doing that calculation. I am trusting you, whatever you are giving it to me. Okay. 0.10 plus 1.7 and 5%. Answer is what should be the answer? 18.5. Very good. Okay. So now this part of the return that you got, 16.5%, okay, 14%, and so I write it here for you, versus 16.5 versus 14% versus 15.5% versus 18.5%. Okay. Now you see that there are two rates, right, given in this part. First is what is happening in the market, that is 17%. Okay. And second is what should be the return, that is 16.5. Okay. So if you remember this formula, P D R minus G, because G or D will remain same, right? If the existing shareholders are requiring 17%, but CAPM says that they should require 16%. If they are requiring 17%, the price will be lower, right? Right? But the CAPM says that they should use 16.5%. So what should be this situation? Will this stock be overvalued or undervalued? Undervalued. Very good. Very good. Okay. So in the market, again, they are requiring 14% higher than what CAPM says, right? So this is also undervalued. This is also undervalued. And CAPM says you should require 15%, but in the market, people are also requiring 15%. So it is, we call it as, this is fairly valued. The last one, CAPM says that you should require 18.5%, and you should use RE as 18.5, but people are using 18%. In this situation, the price will be higher. So the situation will be overvalued or undervalued. Now, very good. Now let me draw it. So I will ask you to draw this. Okay, I will ask you to draw this. Okay, so first of all, when there is no risk, mean when there is risk, and then return mean RE. In this question, risk is beta. Okay, risk and return. So first of all, when there is no risk, it means when there is no risk, this part of the CAPM will be cancelled. So only thing will be left is risk-free rate. So when there is zero risk, there is risk-free rate only. And in this question, it was equal to 10%. So when the risk increases, beta increases, this should also increase. Okay, this should also increase. So let's put the information. So when the beta is 0.8, and the beta, because this is the lowest beta, right? How much should we expect? The question said that you should expect 14%. Okay, 14%. So this is, I'm writing 14%. Okay. So when the beta is 1.1, let's say this is 1.1, how much should we expect? 15.5%. So let's say 15.5%. Okay, this is written here. So when the beta is 1.3, we should require 1.3, yeah, 16.5, slightly up, 16.5%. Okay, so when the beta is 1.7, we should require 18.5. Okay, so this is at this beta 18.5, this is this beta, and this beta. And this line that we draw is called security market line. Okay, SML. Okay, now this is all the points here that you draw. All the points here that you draw should be based on CAPM. Remember, okay, all the points that you draw based on beta should be the answer that you got from CAPM. Okay, and the decision for the undervalue or the overvalue should be, okay, now let's take our first one. When the beta is 0.08, use another color. Yeah, when the beta is 0.08, CAPM asks us to ask 14%, but market is saying how much? 14.5. So I'm writing 14.5 slightly up there. Okay, so this is CAPM is saying you should expect this, but market is saying accept, you should require 14.5%. So if I underline this one, so you say that this is undervalued or overvalued, students? First one, CAPM says that you should require 14% when the beta is 0.8, but in the market, people are requiring 14.5%. So is it a case of undervalued or overvalued? Undervalued. Very good, very good. So that is why I actually wanted to draw it here, because students normally they get confused, because the 14.5% is above this CAPM line, so they misinterpret it and they call it as overvalued. So this is not overvalued, actually this is undervalued, mean the asset price is undervalued. So if you use this 14.5% here, and if you use the CAPM rate, which one will give you lowest price? This one. Okay, so if we use 14.5, the answer of the price will be lower, so it means underprice. So if you use 14%, it will give you highest price. So that is why, don't get confused if you are writing the rate above this line. So it will not make it overvalued, it will make undervalued, because undervalued means the price is lower than what the CAPM is suggesting. Okay, so for 1.1, CAPM is saying that you should expect 15.5, and market is also expecting 15.5, so no issues for this stop. So this is fairly valued. Okay, for 1.3, CAPM is saying that you should expect 16.5% as RE, but in the market, investors are requiring how much? 1.3, 16.5. Yeah, it is 17%, right? investors are requiring 17%. Again, this is a case of overvalued, undervalued. So this asset is also undervalued. So last one, CAPM says that you should expect 18.5%, but market participants are currently expecting 18%. So it means that they are expecting low, right? But CAPM says that they should use higher return, higher RE. So at this, they are requiring 18%. They are requiring less. So they should require more according to CAPM. So when you use 18 here, the answer of the price will be higher. So it means the price at this point will be higher and the price at this point will be lower. So this point is called overvalue. This stock means this stock is overvalued. Okay, so don't get confused between the overvalued and undervalued. So you need to draw the SML based on CAPM. So once you draw that, then things are very easy to calculate. Okay, and if you see, this is already given here. Okay, so SML line, you can draw it. So in the next question, they have just decreased the risk-free rate. Risk-free rate increased from 10% to 12%. Market interest rate, the market return, they have changed from 15% to 16%, and then they ask you to calculate. Simple. There is nothing additional that you should be worried, but you should know how to apply these concepts. Okay, so this is this in A, the last one is overvalued, is undervalued, fairly valued, and then undervalued. Okay, any questions, students?